This section covers regulatory requirements for trading, including information about obtaining, verifying, and confirming customer purchase and sale instructions. FINRA has what's called the Uniform Practice Code. It sets forth some requirements for trading. The Uniform Practice Code describes regular way settlement. That means that T plus 3 days is allowed to settle a transaction, regular way, T plus 3. The Uniform Practice Code also reminds you that confirmations must be sent the business day after the trade date. So confirmations are always in writing. Confirmations will disclose whether or not the firm acted as a broker, and if they did, what their commission is. FINRA Rule 2232, customer confirmations. So building on what we were discussing, confirmations are sent, required to be sent, confirmations must be sent business day after the trade. If the transaction is in a national market system stock, the confirmation must include the settlement date. If the transaction is in regard to a callable equity security, the confirmation must disclose that the security is callable and that the customer may contact the member for more information concerning the security. So confirmation sent, we said, business day after the trade date. FINRA Rule 2232 says confirmations should be sent at or before the completion of the transaction. So written notification, confirmation. So we talked about in the previous section what is on an order ticket. Now a potential question is what is on the confirmation. So SEC Rule 10b-10 describes what is on the confirmation. Date and time of the transaction, identity, price, number of shares purchased or sold by the customer. So we're going to put these on the board because they do like these. They like you to know what was on the order ticket, and now they like you to know what is on the confirmation. So date and time of transaction, identity, 100 shares of Lululemon stock, price, number of shares, 100 shares of Lululemon at $50 a share on the confirmation. Also, when the broker-dealer is acting as a broker, I had said this already, they must disclose the commission charged, so broker-dealers act in a transaction with a customer either for the customer, which is the broker side of the transaction. We sometimes call that acting in an agency capacity. Or they act as a dealer, which is a principal. If it is a dealer transaction, they do not have to disclose the markup or markdown. If they're acting as a dealer, they must disclose if they are a market maker in that security. So do they have an inventory position? Or do they make the market in that security? If they're acting as a dealer, they must disclose if they are market makers. We have FINRA and NASD rules in this section as well. Some more rules and books and records. FINRA Rule 4514 talks about authorization records for negotiable instruments. No member or person associated with a member shall obtain from a customer or submit for payment a check, draft, or other form of negotiable paper drawn on a customer's checking, savings, share, or similar account without that person's express written authorization, which may include the customer's signature on the negotiable instrument. When the written authorization is separate from the negotiable instrument, the member shall preserve the authorization for a period of 3 years following the date the authorization expires. So a lot of times these transactions aren't done with checks anymore. Who has a checkbook anymore? I suppose there's a few bills we'll always pay with a checkbook, but so oftentimes we have transactions, the purchase of mutual fund shares that happen through electronic funds transfers. So the firm, all broker-dealers must have authorization records to initiate that withdrawal out of the customer's checking or savings account and keep those on file for 3 years from when the authorization expires. FINRA Rule 4515 is the rule about how do we handle the change as far as an account name change or a designation change. This rule requires that before a customer order is executed, the account name or designation must be on the order ticket. We talked about that in the previous section. And what would happen if the order ticket had the wrong name or the wrong designation, so the wrong account number was on there? Anytime there is an account name or designation that takes place on the order ticket prior to the execution of a trade, a principal, someone with their 26, must authorize that change, and they must document the essential facts that the principal relied upon in approving that change. These things must be done prior to execution. It's perfectly fine to use electronic means to satisfy both the approval and documentation requirements of this rule. FINRA Rule 4515 also allows that a broker-dealer can accept orders from investment advisors and allow investment advisors to make allocations on their orders for customers on whose behalf the investment advisor submits the order, if the rule is followed, so long as the firm receives specific account designations or customer names from the investment advisor by noon of the next business day following the trading session. So if the transaction was on a Monday and the investment advisor placed an order that was routed through this broker-dealer, and it was an order to buy 10,000 shares of Apple stock, the investment advisor must provide to the broker-dealer by noon of the next business day the persons, the account name or designation, to whom these shares are being allocated. So it's very common that the investment advisor is going to aggregate the transactions. So maybe 100 different clients and they all got different amounts of those shares. The investment advisor must tell the broker-dealer to whom those shares are being distributed. FINRA Rule 5310 is the best execution and interpositioning rule. Today, there's so many different trading venues that actually exist in the secondary market. So a lot of times we focus on, particularly with a class like the Series 6 class, the New York Stock Exchange and the NASDAQ stock market, but that's not the only exchanges today. So there's different pools, we call them dark pools, where a lot of institutional transactions take place. There's the BATS exchange. So there's different places where a security may trade. So a broker-dealer has an obligation to use reasonable diligence in processing a customer's order to ascertain the best market for the subject security and buy and sell in that market so that the customer gets the best price that they can. So if they're buying, it's the lowest price you can get for them. If they're selling, it's the highest price you can get for them, given the prevailing market conditions. So best execution rule. FINRA is going to look at various factors to determine if a firm follows this rule. So some of the factors that they'll look at to determine if reasonable diligence were used. The character and market for the security, things like the price, volatility, relative liquidity, and pressure on available communications. They'll look at the size and type of transaction, the number of markets checked, the accessibility of the quotation, and the terms and conditions of the order which result in the transaction as communicated to the member and persons associated with the member. The rule says in any transaction with or for a customer or for a customer of another broker-dealer, no member firm shall place in between the member firm and the best market a third party for the purposes of generating an additional or a false commission or a false fee. It's called interpositioning. It is prohibited. So no placing for no real purpose except to generate additional revenue can you have that third party interjected between the member firm and the best market for the transaction. When a broker-dealer receives a customer order that is a market order, the member must make every effort to execute the marketable customer order that it receives fully and right away, promptly. I've mentioned that before. Sometimes broker-dealers will allow the customer to tell the firm which market to route their order to. So if a member firm allows this, then the member firm is not held to the best execution portion of this rule. They're still going to be held to the timely processing right away, but they're not going to be held to finding the best market because they told the client they could choose what market to route the order to. FINRA Rule 11.860 is in regards to COD orders. So before I can really talk about the rule, I have to give you a little bit of background. We need to learn about clearing agencies. Clearing agencies are self-regulatory organizations. So SROs, they have to register with the SEC. There's two basic types of clearing companies, clearing agencies. So within the topic of clearing agencies, you find clearing corporations and depositories. I almost can say historically, you'll see. So clearing corporations and depositories. So once upon a time, the securities market was basically a place that had stock certificates. And one person would buy a stock and then the certificate would go to the other person, right? The seller would give the certificate to the buyer. Well, today, think about the volume of shares that trade every day in the secondary market. Nobody is really doing that anymore. We're not moving physical stock certificates from one party to another. Generally speaking, we're not doing it. We're doing it all electronically. But historically, so clearing corporations did this historically, and they do some of this still today. Clearing corporations compare member transactions, clear trades, prepare instructions for automated settlement of those trades, so instead of the actual exchanging of certificates. And often clearing corporations will act as intermediaries in making those settlements. We have a couple of big clearing corporations here in the US. So the National Securities Clearing Corporation, the Options Clearing Corporation, and the Fixed Income Clearing Corporation. Of those, the one most commonly referenced would be the National Securities Clearing Corporation. The depository is where the securities are held in bulk form. So the clearing corporation, the depository, serves its members. So they have organizations that belong to them. So different broker-dealers will belong to different depositories and or different clearing corporations. So the depositories actually have or had the stock certificates physically. They maintain ownership records of the securities on their own books. The Depository Trust Company is the primary securities depository in the U.S. So the Depository Trust Company. So kind of like putting something in a safe deposit box, there's actual physical securities maintained there. Clearing corporations will generally instruct depositories, in the old-fashioned way of doing business, to make securities deliveries that result from settlement of securities transactions. Depositories also receive instructions from participants to move securities from one participant's account to another participant's account, either for free or in exchange for a payment of money. For example, my son has shares at Disney. I reference this throughout the course. Disney will no longer issue physical stock certificates anymore. That's a new rule that they set forth. So having actual physical certificates is not common anymore. In 1999, the National Securities Clearing Corporation and the Depository Trust Company joined forces to become what we talk about today, which is the Depository Trust and Clearing Corporation. So they're really both owned by a holding company, Depository Trust and Clearing Corporation. And this is where the clearing, the guarantee of the actual transaction is done, the exchanging of the securities is done in a book entry format today. So the DTCC delivers clearing and settlement services to its members. They do most of the business here in the United States. So that's a little bit of background on what we're talking about here as far as clearing agencies go. So the term collect on delivery refers to a purchase by a customer, and payment on delivery refers to a sale by a customer, wherein a broker-dealer receives or makes payment at the time the securities are delivered. POD or COD customers may be individual investors, but they aren't usually. This type of a designated transaction is usually done by institutional traders. So the bulk of trading, over 60% today, is done institutionally. So banks, insurance companies, registered investment companies, those are mutual fund companies, pension plans. Oftentimes they will request that securities are purchased on a COD or POD basis, delivered to a clearing agent, generally a bank, that will receive the securities and make payments. Some COD and POD transactions used to be allowed to be settled with that physical exchange of the security certificate. But you can kind of think about, as the market started to speed up, how long that would actually take to physically do this. So we had delays in securities processing when we were allowing for the physical actual settlement of securities. The depository had to have enough stock certificates in working denominations to accommodate deliveries by depository members to customers outside of the network. This caused brokerage costs to be more, depository costs to be more. So over time, rules have changed. So basically what the rule says today is that all depository eligible COD and POD transactions that are executed by a broker-dealer for a domestic customer must be processed through the confirmation and book entry delivery facilities provided by registered clearing agencies and depositories. So it's basically saying no more physical exchange of securities. POD and COD transactions must be done in book entry format. So we talked about who are the clearing agencies that are out there right now. We talked about the Fixed Income Clearing Corporation, the Options Clearing Corporation, and then we have the major one being the NSCC. Just the definition under this rule, though, of clearing agency. Any person who acts as an intermediary in making payments or deliveries, or both, in connection with transactions in securities, or who provides facilities for comparisons of data respecting the terms of settlement of securities transactions, to reduce the number of settlements of securities transactions, or for the allocation of securities settlement responsibilities. A depository eligible transaction, what does that even mean? Because we said all depository eligible transactions must be done in a book entry system. So depository eligible transactions are transactions in those securities for which confirmation, affirmation, or book entry settlement can be performed through the facilities of a clearing agency. Eligible sinking funds and or dividend reinvestment transactions must be confirmed, acknowledged, and book entry settled through the facilities of a registered securities depository. So we've got the Depository Trust and Clearing Corporation doing the bulk of these transactions. NASD Rule 2340, Customer Account Statements. If you have a brokerage account, your securities firm must send you, no less frequently than once every quarter, an account statement. So your account statement must contain a description of any securities positions, money balances, or account activity. So quarterly statements. So broker-dealers must send. And remember, send is not always physical. You can opt into the electronic delivery of all of these things, quarterly statements. So if you've got money at a mutual fund company, they have to send you a statement either in the mail or via email if you've opted into that. Which, you know, save a tree, I suppose. You might as well. On the customer account statement, it must include a statement that advises the customer to look at the statement and please tell us right away if there's any inaccuracies or discrepancies. The customer account statement must remind if the customer is serviced by both an introducing and a clearing member firm that the customer should notify both the introducing and the clearing member firm of any discrepancies. If the notification of a discrepancy is done orally, so if you called them up and told them, you should follow up with the discrepancy in a written format, just to make sure the customer should do this in writing to protect their rights under the Securities Investor Protection Act. Federal Reserve Board Regulation T. Reg T has to do with how much a broker-dealer can require you to deposit in what is called a margin account. So a margin account is where the broker-dealer lets you have a loan to buy securities. So Regulation T sets the initial margin requirement at 50% or $2,000, whichever is greater, which I'll show you how that works. Regulation T also says when the customer places a trade, regular way settlement is T plus 3, but under Reg T they have T plus 5 business days to pay. So you really tell the customer T plus 3, and then if they don't pay you by the third day, there's 2 more days because Reg T gives them 5 business days that they have to pay you before they will be in big trouble. So if they don't pay you by the 5th business day, their account will be frozen for 90 days. All subsequent transactions must be paid for in cash in advance. So their account won't be closed. It's just that we just kind of, in a way, extended you credit, and if you don't pay us by the 5th business day, we're not going to do that for you again. We're going to sell off the trade. If we make money, we'll keep it. If we lose money, you're going to owe us for that. So Reg T sets forth 2 different things. It sets forth the initial equity in a margin account. So I'll show you. So if you're going to buy, let's say, 100 shares of stock at $50 a share, in a cash account, that would cost you $5,000. You can buy stock long in a cash account, or you can buy it in a margin account. So if you're buying $5,000 worth of stock in a margin account, they're going to make you deposit as equity 50%, or $2,000, but 50% is greater. So you actually only have to deposit $2,500, and the difference is what we call the debit balance. That's the loan amount. Broker-dealers love to loan you money because then they'll charge you interest on the loan. So you buy securities by putting half down, basically, and then you hope and pray in a long margin account that the market value goes up. So Reg T is the initial margin requirement. So if it said Reg T was 60% and you were buying $5,000 worth of stock, that means you would have to deposit $3,000. So you could borrow the difference. So Reg T is what you deposit as equity. That's initial. Over time, the equity can get as low as 25% in a long margin account before you have what we call a margin call. So if the value goes down, because remember, in a long account, you want the value of the shares to go up. If the market value goes down too much, below 25%, you'll have a margin call, where you'll have to deposit more cash or more securities. You can never purchase new issues in a margin account. Thus, open-end mutual fund shares can never be purchased in a margin account. You can use open-end mutual fund shares that you've owned fully paid for 30 days or longer as collateral in a margin account. When you're in a margin account, you must sign a hypothecation agreement. To hypothecate your securities is to pledge them as collateral for the loan. So we had family friends that they sold their business, got a bunch of stock, put all the stock into a margin account, and then the value went down and they lost everything because they didn't have any more money to deposit, and then the broker-dealer just started selling off their stock. Margin accounts are risky. They are not suitable for everyday average investors. Not suitable for them. So that is Reg T, T plus 5 business days to pay. When you hypothecate your securities, the customer signs a hypothecation agreement, and the securities are kept in street name, which is the name of the broker-dealer, and that's just done to facilitate their ability to sell them quickly. FINRA Rule 2080. This has to do with a little bit of information kind of back to the very beginning of the course. So we're at the end of the course reviewing the beginning. Remember, I didn't write the outline. So the course is organized by the critical functions on the examination outline, and they don't always make as much sense as they should as far as where they put the information. But this has to do with you're a registered rep, and there's a customer dispute that has ended up in the CRD system, so the Central Registration Depository System. Your U4, your registration forms, that's all filed through the CRD system, so it's an electronic system. So we reference you have a CRD number once you're registered, and you want to expunge the information. So certain information in the CRD system you can't ask to have removed, but sometimes you can ask to have a customer dispute expunged from the CRD system. So if a member or an associated person is seeking to expunge information from the Central Registration Depository System as it relates to a dispute with a customer, there's one of two ways to do it. First, you can obtain an order from a court of competent jurisdiction directing expungement, or you can present an arbitration award that contains expungement relief. If you don't have the arbitration award with the expungement relief, then you have to go through this court process. When you go through the court process, you must name FINRA as an additional party and serve FINRA with all of the appropriate documents, unless there's a few exceptions. So if you're asking for expungement through a court of law, FINRA needs to be a party, unless. FINRA will waive the obligation to be named as a party if they determine expungement relief is based upon affirmative judicial and arbitral findings that the claim, allegation, or information is factually impossible or clearly erroneous, or if the registered person was not involved in the alleged investment-related sales practice violation, forgery, theft, misappropriation, or conversion of funds, or the claim, allegation, or information is false. So it's basically saying FINRA does not need to be named as a party if any of those things are true. I mean, think about it. Customers get mad about everything, and they're not always right. So there might be something in the CRD system that you want removed, and this is the process that you would go through in order to have that expunged, erased completely. FINRA Rule 4513 has to do with records of written customer complaints. So if the customer calls you up and is mad at you, make them happy, have them go away. But if you get a written complaint, then the written complaint is what we're talking about. So a customer complaint by definition means any grievance by a customer or any person authorized to act on behalf of a customer involving the activities of the member or a person associated with the member in connection with a solicitation or execution of any transaction or the disposition of securities or funds of that customer. Each member is required to keep and preserve in each office of supervisory jurisdiction either a separate file of all written customer complaints that relate to that office, including complaints that relate to activities supervised from that office and action taken by the member, if any, or a separate record of such complaints and a clear reference to the file in that office containing the correspondence connected with such complaints. It is possible, instead of keeping the complaint records required under this rule at the Office of Supervisory Jurisdiction, the member can choose to make them promptly available at that office upon request of FINRA. This goes back to a rule I referenced in the previous section. FINRA has at longest a 4-year examination cycle for member firms so that written customer complaint records must be kept by member firms for 4 years.